or we should be the mainstream, and we have to replace them. And we're not going to replace them if we keep calling them mainstream. As far as I'm concerned, they're from the history of economic thought, or they should be. We should be the mainstream, and I hope in 2 or 3 years' time we will be. And I don't know what eventually is going to push us towards that. It might be a catastrophic policy failure around the world. It could be the election of a US president who is advised by monetary theory economists. It might be. I don't know, but we're definitely going in that direction. And I think people who are more informed than me talk about it becoming obvious that the mainstream is doomed. Then I listen and I think about it, and I've been thinking about it, and I think they're right.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our patrons so far, and this week a big thank you to our supporter John Biddle, who also sent us a couple of great questions that I got to put to our guest, Dr. Stephen Hale. In part one of this interview with Stephen, which ideally you should listen to before listening to this one, we talked about how government bonds function, which if you're new to this, sounds like it might be a bit of a dry topic. But when you consider the MMT insight that a government that issues its own currency can never run out of that currency, and therefore never needs to borrow any amount of that currency from anyone, and in fact the dollars or pounds or yen being used to purchase bonds from the US, UK or Japanese governments could only have come from those respective governments in the first place, it raises the question, what are government bonds for? And that's what these two episodes are all about. So just to recap some of the terminology from last week, a government bond has a face value or a par value. Like a £10 note has a face value of £10, a £1,000 government bond has a par value of £1,000. But unlike a £10 note, a government bond has a coupon rate. So a £1,000 government bond with a coupon rate of 10% pays £100 every year until it matures, at which time the bondholder gets their original £1,000 back and their £100 coupon payment for that final year. By the way, a 10% coupon rate would be very high these days as I understand it, but I chose that number to keep the maths simple. The number of years a bond will exist for is called its maturity, and the length of maturities can be anywhere from a month to more than 30 years. All of these previously mentioned conditions are fixed by the bond issuer. But when a bond is sold, a purchaser can bid for and get the bond at a lower price than its par value. So let's say a 10-year maturity £1,000 bond with a 10% coupon rate gets bought for £900. In that case, the purchaser, the bondholder, gets £100 every year, and the year when the bond matures, the bondholder gets £1,100 as per the previous example. But also, because this bondholder that got this particular £1,000 bond for £900, they also get an extra £100 because the purchaser got the bond at £100 lower than its par value. Now, this return to the investor is known as the bond's yield. So you can see that when the bond is sold, the lower the price the purchaser can get the bond for below its face value, the higher that bond's yield is. So it's a little bit complicated, but hopefully you can see that government bonds are a totally risk-free investment for people who buy them from governments that issue their own currency and therefore have no default risk. Or, as primary MMT academic Bill Mitchell puts it, government bonds are corporate welfare. They give free money to people and institutions who already have money. It is a way for a government to inject money into an economy, but seeing as the people with the most money get the most of that free lunch, and those with the least get the least, and most of us have zero, so get zero, gotta say, I'm not a fan. So hopefully you're getting the point of understanding modern money, of understanding that a monetarily sovereign government doesn't actually borrow its own money, which it can create at will when it sells bonds. Your government can and does spend whatever it wants, whenever it wants, on whatever it wants without financial limit. In other words, given that our governments work for us and are supposed to work for all of us, I think we could do better than corporate welfare as an economic policy. Here in the UK, I feel like we could do with a bit more actual welfare, a lot more spending on actual public goods and services, including our NHS. In this interview, you'll hear me and Stephen talking about Bill and Warren and Stephanie. In the highly unlikely event you don't know who we're talking about, they are Bill Mitchell, Warren Mosler, and Stephanie Kelton. Stephanie being Bernie Sanders' chief economist. It is well worth looking at all their articles, books, and talks online. Like I say, in the highly unlikely event you haven't already. So we pick up the second half of our conversation by talking about an article by Bill Mitchell, which is called Inverted Yield Curves Signaling a Total Failure of the Dominant Mainstream Macroeconomics. And I've linked to that in the show notes. Okay, let's dive in. So, in the auction process, the government, so I'm quoting from Bill again, the government determined the maturity, how long the bond will exist for, the coupon rate, which we've talked about, the interest return on the bond, and the volume, how many bonds. How do they decide how many of each maturity they will issue?
Oh, God.
Sorry.
They have a variety of things they take into account, but one of them is they basically look at the liquidity of the market and where they think the demand is.
Okay.
What they think institutions want to bid for.
Right. So they're trying to make it attractive to institutions. And when we say institutions, not just the primary dealers, but like the market, the secondary market.
Fund managers as well, yeah.
Yeah.
We're talking about almost exclusively institutional investors. Some private investors own government bonds, but for the most part, they are owned by the market makers and wholesale investors like pension fund managers.
So, and let's just draw a distinction between the primary and the secondary market as well. So the primary dealers, if you had to guess off the top of your head in the UK, I in my mind, when I think of primary dealers, I'm thinking like a bunch of institutions, maybe 30 tops.
The big banks, I think there's a few. It's a few less than that, but people can find out for themselves. What's it called in the UK? The Debt Management Office. Right. Okay. If you just Google Debt Management Office, HM Treasury, then there is a list of the gilt edge market makers on there.
Right, great. I will look that up, actually. I'll put it in the show notes. So you've got these primary dealers, and they are obligated to bid in a certain number of auctions. I know there's been some controversy about that online, people saying, oh no, they don't have to bid. So there could be a chance that they would never bid. And, in law, it's not the same as the States in the UK. But Warren Mosler says, well, the system's been going for a long time. Do you...
Why would they not bid?
Yeah, exactly. Yeah.
Because they're not, when we say they have to bid, they don't have to bid at the par value. They don't have, actually the bids they give are for yields, which then implies the price they pay for a bond. But they don't have to bid at the coupon rate of interest. They can bid at a higher rate. They could be looking for a higher yield to maturity or market rate of interest than that. Bonds are not issued at their par value. They're issued at what the institutions bid for. So
why would you not bid on money that pays money?
Why would you not bid on money that pays money, particularly when you can bid a high interest rate?
Yeah.
If you bid too high for the yield, then actually you won't get any of that particular bond issue.
Yeah.
But there's no reason not to bid. It wouldn't matter, though. I mean, as I said, we don't need to issue the bonds at all.
Yes, yeah.
We only issue them, really, in the UK, whatever reason the government might give, either sort of anachronistically because we've always done it, there was once a good reason for doing it, there isn't anymore, but we still do it, or if you want to be more cynical, because those institutional investors would complain if you stop doing it.
Yeah, and most
don't need to do it.
What Warren's take last time I spoke to him, he was saying, "Oh, the auctions have been clearing for years, so something's going on." And then he also said something like, if all of a sudden the primary dealers stop bidding, do you think the government would just go, well, we'll shut down until the government will just go, we'll shut down until you guys are ready to buy bonds again, then we can't do anything, or will they just change the institutional arrangements? And then he made this joke about a person with £100 who wants to buy something for £100, but he won't because the money's in his left-hand pocket, and that's not his paying pocket. What do you think? Do you think he might just move the pocket? Move the note?
You can have an argument about how the current institutions work, or you can say, as I would say, and I think I agree with Bill about this, issuing government bonds is pointless. Just stop doing it.
Yeah, sure, yeah.
We don't need them to buy it, so frankly, who cares?
Yeah,
just don't issue it.
Yeah.
Stop paying out a return on zero risk money.
But then Bill does talk about the time when Australia were running surpluses, and as the bond market got thin, the complaints to the government came from the Sydney Stock Exchange.
Yes, well, if you've ever watched, some people have seen a talk I did in 2014. It's the video of me, which much more people have seen that than any other one, because it's had 25,000 hits on YouTube. It was a talk on budget emergency in 2014. The government was talking about a budget emergency. I slightly took a slide from a Treasury presentation out of context, because I used a slide from the Australian Treasury where they were explaining, and this was during the period when there were budget surpluses, that bond issuance was not with the purpose of funding government spending. And I said in the talk, I'm going to use this slide, although I'm taking it slightly out of context, because just for once, even though they did it by accident, this is a public servant telling the truth. Even when there are deficits, bond sales are not about paying for government spending. That's not their purpose. But that became obvious, as Bill pointed out, during those years of surplus. And by the way, the presentation that I took a slide from for my talk got taken down. You can't find it anywhere now.
Right. So apart from in your talk.
Well, I think someone in the Treasury saw that I'd used it, and this is years ago. They might not do it now. These days, it's not. I haven't done a talk at the Treasury, but it's not impossible that you might be asked to give a talk at the Treasury in Canberra if you're an MMT economist, because really, not that government policy is in any way influenced by our view of the world, but there are economists in the government service who are interested. They're much more open-minded, some of them, than some university academics, and they might not listen to us, but they're more interested in, well, they might not. They might not be persuaded by us, but they're more interested in listening to what we've got to say than they would have been years ago. So,
just to follow this through, so we know that they're not selling bonds to fund the government. My question is, when
they think they are.
Yes, of course, yeah. So auctions occur, as I remember off the top of my head, people talking about it, auctions occur every 2 weeks. Sound about right?
Again, I can't remember in the case of the UK, but if you go on the Debt Management Office site, they have, for 2019, 2020, there is a calendar.
Right. Okay.
So they tell you when the auctions are. They tell you.
So it's not
when the bids have to be in by.
Yeah.
And They give you the details in terms of what Bill was talking about, how long the bonds are going to exist for, or their maturity, and the coupon rate of interest on them, all that kind of stuff.
Okay, but they happen on a regular beat rather than an operative at the central bank going, we're just about to run out of funds, let's have an auction in 2 days' time. They happen on a regular beat. That's just, they
happen on a regular basis, as do Treasury bill issues as well.
Right.
Issues of short-term government debt. Treasury bills are a bit different. Probably not worth our while diverting into them.
Yeah,
but they're very short term.
Okay, so what is when the auctions are held and the people at the central bank are deciding, what maturity bonds to issue and how many of them and what coupon rate to set? What's the prime mover there? What is the...
Well, the coupon rate is usually chosen to be close to what they expect the market rate of interest or yield on the bond to be once it's issued.
Right.
Usually. It doesn't have to be, but it usually is.
Yeah.
And as I said, in terms of maturity, they'll be taking into account what investors are looking for.
Right. But then in order to the quantity, because it's fixed quantity, right? They decide how many to issue, the volume rather.
Well, that they know about government net spending, they know its impact on reserve balances, and they still, even though in the UK this really doesn't make sense post quantitative easing, they still try to more or less match government net spending.
So it's not a precise calculation, but a calculation nonetheless.
Well, yeah, the government is spending all the time, every day.
Yeah.
And obviously bonds are not issued every day. So, yeah.
So they're on it. They're looking forward and trying to anticipate, what the deficit will be on at that given time. Maybe.
Over a period of time, yes, I suppose that's in terms of the amount that they issue. As far as the term they issue, they're looking to see where the demand is from investors. So there's been a lot more issuance of very long dated bonds in recent years because investors have been prepared to accept very low rates of interest on long dated bonds, and people in the government, people in the Treasury, they think they're raising money cheaply for the government. You and I know this is not what they do, but many of them think, we can borrow really cheaply over 30 years now. Let's issue some 30-year bonds.
Okay, so
they misunderstand the purpose of what they're doing very often. Right. Many people that were involved in it. Yes.
So we might have covered this before, but let me just ask it again anyway. In Bill's article, he says when interest rates rise, the price of previously issued bonds fall because they are less attractive in comparison to the newly issued bonds, which are offering a higher coupon rate, brackets reflecting current interest rates. Could you unpack that?
That is, in a different way, more or less what we just said.
Okay.
If market interest rates rise, then new bond issues will probably have higher coupon rates associated with them. There's no reason particularly why they have to, but this is the normal practice. Those new bonds are nonetheless auctioned, so the price is paid for them. If they're auctioned when the market rate of interest that investors are looking for on bonds like those are close to the coupon rate on the bond, then the price at which they're auctioned will be very close to the par value of the bond. So, if you like, you can say that the return on those new bonds when they're issued is close to their coupon rate. Bonds which are already out there on the market, well, if you're an investor, it really doesn't matter to you whether you're investing in bonds that have been newly issued or bonds which have been in the market for a while. If a bond which is newly issued with a 10-year maturity is exactly the same as a bond which was originally issued with a 15-year maturity but has got 10 years to run. They're the same as each other. So if that bond that was originally issued with a 15-year maturity but now has 10 years to run, if it was issued 5 years ago with a lower coupon rate because interest rates were lower 5 years ago, the market rate of interest or yield on that bond will now have to rise to match the return that investors would get if they bought newly issued bonds now. Because basically they're the same. It doesn't, as I've said, if you're an investor, they're equivalent bonds. It's how long they've got to run, and that they're both debt of the UK government. It doesn't matter that one of them was issued 5 years ago and the other has just been issued now. In which case, how can the yield or the market rate of interest on those bonds that are being traded on the secondary market that were issued a while ago, how can that possibly increase so that it matches the return offered on new bonds? Well, the only way that that can happen is if the prices of those bonds on the secondary market fall below their par value. Because remember, as I was saying before, if you can buy a bond at a price which is below its par value, you can think of yourself as getting the coupon on the bond, but a bit more too if you hold it to maturity, because you're only paying £900 for a bond which will have a par value of £1,000 on maturity. So you won't just get the interest payments, you'll get the capital gain. You bought £900, something that the government will buy back off you in 10 years' time for £1,000.
Great.
So that's what happened. The prices of those existing bonds will have to fall. And in general, when interest rates, if the whole yield curve shifts upwards, which is the same thing as saying all interest rates rise, short and long term, then all bond prices will fall. There's an inverse relationship there. The cheaper you can buy a bond, the higher the yield you're getting for every dollar you pay, every pound you pay for that bond. Because when you buy a bond, you are buying what is a fixed, predetermined set of cash flows coming to you from the government. The amount of cash the government promises to pay you was fixed when the bond was issued. When investors require a higher return in order to make it worth their while to buy this bond or to continue to hold on to this bond, what gives investors, when they buy the bond now, a higher return than before is only the price of the bond falling, so that you're able to obtain the bond more cheaply than previously.
Got it.
That's basically it.
Yeah. Another quote from Bill. The price of a bond can change in the marketplace according to interest rate fluctuations. Now, he says fluctuations there. Now, differences in interest rates aren't passive, right? They're set by the government. They decide to raise or lower interest rates, and then it happens, right?
Well, official interest rates are set by the central bank. So in the UK, the bank rate is set by the central bank, but that's only a 24-hour interest rate on the interbank market. Right. When you're talking about the market rate of interest on a 10-year bond, like I was saying before, that's influenced by what people expect the bank rate to be on average over the next 10 years. Right. So that is going to be influenced by market expectations, because we don't know under the current arrangements what the bank rate's going to be on average over the next 10 years. So when investors, because they're worried about inflation rising maybe, when they now think it's more likely that the bank rate will be higher in the future, then because of the risk of that, because they expect short-term interest rates to rise in the future, that puts upward pressure on long-term interest rates now. So bond prices fall when that happens. Investors require a higher return to tie their money up in those long-dated bonds, because an alternative would be just to tie up your money short term and then take advantage of the increase in interest rates that you're forecasting happening when it happens. So the expectation of short-term interest rates rising in the future pushes long-term interest rates up now. That's what he's talking about, and that means bond prices will fall now. So interest rates on the bond market will fluctuate because of a variety of factors, but particularly because of changes in market expectations about future inflation rates and therefore future short-term interest rates. That having been said, to return to a point I made earlier, the Bank of Japan has shown everybody, if it was necessary to demonstrate this, because it should be obvious really, that if the central bank wanted to, they could buy and sell bonds in such a scale, because they got limitless pockets, the central bank, that they could dwarf everybody else's transactions and they could set all interest rates wherever they wanted them to be.
Okay, well, that brings...
They don't do that at the moment, but they could do.
I've only got a couple more questions, and this one's from a listener, actually.
Hi, Patricia. Hi, Christian. Thanks so much for what you're doing. Long-time listener here. Firstly, why is it fiscal or monetary policy to have a target of 2% inflation, and why wouldn't you want to target for 0% inflation? And is that something to do with the rent-seeking economy?
Well, first thing to say is there's nothing particularly magical or any great theoretical justification behind having a 2% inflation target. There's no particular great reason why it shouldn't be 6 to 7% or something, apart from the things you can read in economics textbooks, but most of those are not all that significant unless inflation goes really out of control. The reason for choosing, in Australia, the target is 2 to 3%. For choosing 2 to 3% here or 2% somewhere else is, as much as anything else, people don't like inflation. So you want to keep inflation low for that reason. But there are problems if it comes to aiming for a 0% inflation rate. One of those is sort of technical, which is that many people think the way we measure inflation is a bit upward biased anyway, because of a variety of factors, including the fact that we perhaps don't properly take improvements in the quality of what's being produced into account when we estimate inflation. They do attempt to do this, but many people think they don't do it adequately, bearing in mind that some of the higher prices that we pay for things over time reflect improvements in quality.
Sorry, Steve, could you just say those last two sentences again? I had a dropout my end.
Okay, you buy a car this year, it costs more than it did last year. Now, if the car is better, is that inflation? We adjust for that in the way that we measure inflation, but some people think we don't adjust for it enough. This is not the best point to dwell on, but let's just say our estimates of inflation are not perfect in the first place. It's also the case over time that it's necessary for there to be relative changes in wages and prices. And let's think about wages, for example. If there's a shortage of some types of workers and a surplus of other types of workers, it's probably efficient for the wages of those workers where there's a shortage of skills to rise relative to the wages of those workers where there isn't a shortage of skills, maybe to give people an incentive to retrain and go and move over. Or we could be talking about people in the same occupation, but some businesses are expanding relative to others. You get what I'm talking about. Now, if we had zero wage inflation anyway, rather than price inflation, in order for that to happen, if the wages of one group was going up, the wages of the other group would actually have to fall. And usually, historically, there's been resistance to decrease in wages. So first of all, it's easier for there to be movements in relative wages or relative prices when on average wages and prices are rising over time a little bit. And secondly, negative inflation, and there's much more of a risk of a negative inflation rate if you're aiming for zero inflation than if you're aiming for 2% inflation, is dangerous in an economy which, as we were saying earlier, consists of balance sheets, which involve people having debts that they have to service, because if you end up if you have to accept lower wages to keep your job, then regardless of what mortgage rates are, you might find yourself unable to repay your mortgage. You've got cash flow commitments, which are determined in money terms, in what we call nominal terms. And if your wages fall, it becomes difficult for you to make those repayments, and it could cause a cascade of defaults and very severe circumstances. And as far as companies are concerned, if we're talking about price inflation, if prices in general start to fall, well, businesses have got nominal cash flow commitments too. They've borrowed from banks maybe in order to make investments, to employ people, to produce goods and services. If they have to sell those goods at lower prices than before, they've got less cash flow coming in. They've still got to repay their debts to the banks. So there is a danger of what's sometimes called a debt deflation, falling wages and prices leading to lots of defaults by businesses and households and a financial crisis. In general, falling wages and prices is not a good thing. Also, it makes people more pessimistic about the future. And if you are thinking about going ahead with a purchase and prices keep falling, you might defer making that purchase. So a recession could be made even worse. So generally speaking, there'll be exceptions to this, but generally speaking, negative inflation is not a good thing. And for example, in Japan, for much of the last 20 or 30 years, they've been desperately trying to avoid negative inflation. So taking that into account, we don't want inflation to be higher than people are happy with. We don't want inflation to be volatile, so everyone has to worry about how to defend the real value of their savings against inflation. Or we don't want inflation to be high and variable so that it encourages lots of industrial disputes because workers and bosses are arguing with each other about what's likely to happen to the cost of living next year, and so we end up with lots of industrial disputes as a result. There's a variety of reasons why we don't want high and unstable inflation. There's nothing particularly special about 2 or 3% inflation, but we sort of evolved that as a sensible target to aim for. And from a modern monetary theorist point of view, there's no reason not to keep that target, really. You'd prefer 2 to 3% to zero, because zero is very close to minus, and minus inflation could cause problems.
And under ZIRP, the way you would transmit that interest rate would be through paying interest on bank reserves?
When you talk about ZIRP, you're normally talking about a zero interest rate. If there's a zero interest rate, then there would be no interest on bank reserves. Right. When you pay interest on excess reserves at the central bank, that allows you to go ahead with fiscal policy without issuing bonds, spend additional reserves into the banking system, and still have a non-zero bank rate. If you were to do that without paying interest on without paying interest on reserves, then you'd have a zero bank rate, and that's, as I said, what the leading modern monetary theory economists sometimes are referring to when they talk about zero as the natural rate of interest. What has happened in some countries since about 2013, and is particularly the case in Japan and the Eurozone, of course, is that they've gone for negative interest rates. So the official interest rate in the Eurozone, it is the interest rate that the European Central Bank pays on private bank reserves, but it's minus 0.4%. It's not zero. And similarly, the official interest rate in Japan, it is the interest rate that the Japanese central bank pays on bank reserves, but it's minus 0.1%. What we have realised since 2013, if we didn't know it before, is that zero is no boundary where official interest rates are concerned. And for a long time now, there have been negative official interest rates in Japan and in the Eurozone. And in the Eurozone, if we're talking about German government bonds, there have been long periods when government bonds have had negative yields on them too.
Apologies if I'm misrepresenting them, and I'm also asking you to read minds here, but I do recall somewhere in MMT article somebody saying that when we say zero interest rate policy, there would be a tiny bit of interest paid on reserve balances. Does that ring any bells for you, or have I ripped that completely out of context?
A zero official interest rate would mean no interest on reserve balances of the private banks at the central bank. It would not, however, mean zero interest rates for you and me when we borrowed.
Right.
We'd still be paying a positive rate of interest, and that positive rate of interest would reflect the risk that lending institutions were taking when they lent to us, and it might also reflect the extent to which what is sometimes called prudential regulation is being used to limit the amount of lending that those institutions do to people like you and me. So you and me would still be paying a positive interest rate when we borrowed, but our banks would be getting a zero interest rate on reserves at the central bank, and the way that we would run things where we didn't issue government bonds anymore, those banks would have lots of excess reserves because funds the government was spending into the banking system and not taxing back out of it again would just be left there in those reserve balances, and there'd be a zero interest rate on them. As I said, that's what people like Randall Wray mean by the natural rate of interest being zero. If there's deficit spending, it puts additional reserves into the banking system. If you don't withdraw those reserves from the banking system through sales of government securities, and you don't pay interest on those reserves, then the official interest rate will be zero.
Got it. Right. And when you say that will be their interest rate, but you and me will pay a positive interest rate, what determines what that number is?
Well, a variety of factors. How risky we are as borrowers,
right? Okay.
How long we want to borrow for, what the marketing objectives of the bank happens to be when lending to us, how keen they are to increase their market share in whatever form of borrowing we're doing, and the prudential regulation from the financial regulator in the UK these days, that's the Bank of England. We are not in favour of using interest rates to limit, as a way of limiting private borrowing anymore. But that doesn't mean we're not in favour of limiting and influencing the direction of private borrowing. But we would prefer to do that through regulation. So basically the amount of a particular form of lending that a bank would be allowed to do, or how quickly they'd be able to increase that lending over time, would be limited through regulation rather than through forcing up the bank rate and seeing that percolate to higher interest rates in general. Bill and Warren have both, I think they collaborate on it. They've written reasonably detailed proposals for how they would like to see the banking system regulated in the future. And this sort of feeds into that a little bit.
Yeah, Warren's in characteristically concise style said something like, basically, what you should do is just tell banks what they can do. Make it a very short list rather than a long list of things they can't do. Because every time, what happens is they keep finding the loopholes, they keep finding ways around it. Then you have to add another thing to the list of things they can't do, and then they find a way around it, and the list grows longer, and the behavior doesn't really change. So he's saying you should start with a list of things they can do, and if they want to do something in addition to that, they lobby you.
Absolutely, yeah. Well, I'm sure that I defer to Warren and Bill, where many things are concerned, including on banking regulation. There might be minor differences between the two of them. I think Billy's probably keener on nationalising the banks than Warren is. So basically, they agree with each other.
Actually, when we spoke to him, maybe this time last year, me and Patricia spoke to him, and as I recall, he said something like, just have a public option bank, to run alongside, and then that sets the standards of what banks can't get away with.
Absolutely, and we used to have a public option in Australia. The Commonwealth Bank used to be a government-owned bank until the 1990s, and then it was privatised. And you had a perfect way of offering people a public option in the UK after the financial crisis. Those banks that the government temporarily nationalised, they could have. Yeah, they could have just. Yeah. They could have, but they could equally well just set up a government banking option.
Yeah, and again, that doesn't take anything away. It just adds, doesn't it?
Well, absolutely. It would take away quite a lot of profit from the big banks.
Well, okay.
It
doesn't take away anything important.
No. I personally, in an ideal world, I wouldn't have private sector banks that were not mutuals. In other words, I wouldn't have ones that are listed on the commercial banks that are listed on the stock exchange. I'm very keen on the what we call credit unions over here, and mutual banks, what used to be called building societies in the UK, those kind of institutions. If you're going to have private banks such as we have at the moment, well, the big four banks in Australia, economies of scale are not all that important in commercial banking. And those big four institutions that we have in Australia, and I guess it's a bit like this in the UK, they're too large. They have too much political influence.
Yeah.
We've just had a Banking Royal Commission where they've been roundly criticised, and there are going to be some changes in the way in which they're supervised, but they'll be relatively minor, and many of them will be reversed over time just because of the influence of the institutions. So if you're going to have private banks, I'd like them to be smaller than they are at the moment. They don't need to be as big as they are at the moment, or perhaps I'd like there to be a big public sector alternative that people could turn to. But that's just the beginning of it. As I said, then the issue of how you go about regulating commercial banks and limiting what they're allowed to do, there's no greater expert on that than Warren Mosler.
Wrapping up now, this is like the second question from our listener.
Second question is about a guy called Scott Smith, who I think is from Colorado, who ran for president in 2016 on the idea of introducing a payment tax, or I think what Labour is calling a transaction tax, or Bernie is even proposing it, a tax on Wall Street, meaning a tax of around about 0.1%, 0.2%, on the theory that there's, around $4,000 trillion in circulation in the US, for example. He lists in his book that there's 1,000 trillion just in the commodities market. The derivatives market is around 800 trillion. And what we look at in terms of salary and what we currently tax on income is a tiny percentage of the amount of money that's actually moving through the economy at any one time. And so really the question is, have you heard of it? And what do you think the implications of that would be? Because I'm guessing that it might reduce smaller transactions on Wall Street. It might reduce some speculative trading. And so the actual amount of money might be reduced in total. It would also mean that you would be almost getting rid of income tax down to just 1/10 of 1%, or in England he reckoned that you'd have to have it around 4/10 of 1% in order to cover the current government spending. And this is on the understanding that taxes at the macro level don't fund spending, but you still need to tax some of that money out of existence. So, really, the question is, what do you think of that?
So I will just add on to that, Stephen, that I think he's talking about a Pigovian tax or the Tobin tax.
Well, it's a Tobin tax. It's I mean, in a sense, it's a Pigovian tax. I don't. It's a bit late in the day for me to explain what a Pigovian tax is, unless somebody was really interested. The transaction tax is a financial transaction tax is a Tobin tax. A tax like that, first of all, the revenue from it would not be as high as people anticipate. More likely than not, because if it acts as a Pigovian tax as well, then if there are, and you think of there being big negative externalities or social costs associated with these activities, then the tax might lead to a significant decrease in the amount of those transactions taking place. But I'm not really attracted to the idea personally, because as far as those derivative transactions are concerned, we're just going to ban them. I mean, most of the derivatives that are traded on Wall Street would just be illegal. And so the activity wouldn't exist anymore.
Yeah, if you want it to not exist, just make it law instead of tax, because we don't need the tax money to spend.
Some derivatives play a useful role when it comes to risk management, and they're relatively simple and straightforward. And those derivatives, to allow businesses to insure against risks like foreign exchange risk, they should be permitted to continue, although they should be kept simple and standardized. But most of the derivative transactions that take place on Wall Street play no useful social function, and they should just be banned. Then you wouldn't have anything to tax.
The other problem with the Tobin tax is that it rhetorically, in politics land, it ties your spending to being able to get, in inverted commas, the income from this tax. So what happens if we don't?
But you wouldn't get as much tax income, if you want to use the word income. We shouldn't really,
exactly,
as people are forecasting anyway. But secondly, absolutely right. I mean, why are we buying into this nonsense? Taxes don't pay for government spending in the first place. The US government is not short of dollars to spend if it wants to, do so. And if you, if you want to be, it's not a very progressive thing to say, but if we're talking about taxes that did have their main impact on very wealthy or very high-earning individuals, then, great, as far as making the distribution of income more even, because the distribution of income and of wealth in the US is scandalous. It's back where it was in the 1890s or 1920s. The US is looking over the precipice as far as income distribution is concerned. Something has to happen. Just as I saw a video recently where Joseph Stiglitz was saying this, the US pulled back from the brink of excessively high inequality in the early 1900s, in the progressive era, and then after the 1929 Wall Street crash and post-Second World War, they need to do that again. So if taxes help with that, fine, but taxing rich people isn't all that useful directly when it comes to limiting inflationary pressures in the economy, because they tend to save a high proportion of their income anyway, rather than spending. So in the MMT description of the macroeconomic role of taxation, the tax that we were just talking about wouldn't really achieve very much.
Maybe what we're talking about is what is going to limit the political power of the ultra-rich in a way that makes elections a little less skewed, and the narrative in general, the stories that emerge that shape people's worldviews when they're going into elections. The the Conservative side just have way more money to chuck around? What is gonna, the 1%, obviously, what's gonna limit their ability? Because it doesn't seem to be a question of taking the money off them. It's
lots of things you can do. One of the things that you could do is comprehensively re-regulate the financial system and make many of the activities that take place on Wall Street illegal. That's one of the things you could do. You can just close them down. You can make them unemployed, or you can offer them a place in a job guarantee scheme, should they want to take. But there's lots of other things you can do as well. You can pursue more industrial democracy. You can look for, in bigger organisations, worker representations on remuneration committees.
Yeah.
There are plenty of things that we can do to change the pre-distribution of income, to, in other words, not work through the tax and welfare system. But I personally, although this is not true of all MMT economists necessarily, but I personally am also in favour of a much more redistributive tax system. I am, regardless of the political problems involved, I am in favour of marginal tax rates on people with higher than average level of earnings going up significantly. I think the flattening of the tax system and the movement away from a progressive tax system that's happened in many countries during the 1980s and 1990s and is still to an extent happening today has been disastrous. So I think that's part of it as well.
Thanks, Stephen. I'll ring off now, and I can't say thank you enough. This really helps me, and I know people listen to this stuff, and it really informs their thinking, and we're going to get there.
We're getting there quite quickly, actually.
Yeah.
That's what I always say to people when they say, "Oh, what can we do to make some progress?" I often say, well, I sat at a conference listening to Bill Mitchell at the University of Newcastle towards the end of 2013, and he was absolutely brilliant, as he always is. But I sat there and looked around me. There weren't all that many people there, and I thought, what's the point? What's the point sitting and listening to all this stuff? And there's a genius who's in front of me explaining. I can't remember what he was explaining at the moment when I had this thought. But I thought, I don't think we're ever going to get anywhere. But you know what? That was 2013. We're less than 6 years on from there. And the change is amazing. Everywhere you could say this. But in Australia in 2013, there were a handful of people who had any idea about modern monetary theory, and almost nobody seemed to be interested. Now, there are hundreds and hundreds of people that could explain it and the basics, and it seems that virtually everybody's interested. Bill and Stephanie and people like that, they're being asked to give talks in big financial institutions and governmental institutions around the world, and every major newspaper is having articles where they're talking about MMT, or where the whole article about MMT, and it's changing a bit too. Even across this year, it's changing. The average tone of those articles is becoming less dismissive and ill-informed and much more interested and receptive and more balanced. It's fantastic that Stephanie is coming to Adelaide, and if I can just mention it, that we're going to hold a conference about the Green New Deal and modern monetary theory in Adelaide from the 10th to the 12th of January, and she's going to be the key speaker at that. She's going to then be doing a big set-piece lecture for the university on the 14th of January. I can't wait for her to be in South Australia. I have so many people lined up that want to meet her. But a year or two, or certainly 5 years ago, this could never have happened. The world is changing.
And Warren says this all the time. I warn you, once this knowledge strikes you, you never go back. So, it's almost like he said that at the talks that he gave in Scotland. So it was almost like he was saying, Warren's a very positive, upbeat person, but to me, it's like, welcome to hell. Welcome to opening every newspaper and just being sick to your stomach about the way they talk about these spreadsheet entries.
I have hundreds of students who say the same thing.
Yeah.
This is the reason why, in the end, we're bound to win, because nobody ever goes back. And how could you? Once something becomes obvious to you, as far as the basic fundamentals are concerned, and it's something which is obviously correct, you're then not going to choose a frame which is incorrect. And I really do think that 2020 or 2021 are going to be the years when we see a really major shift in macroeconomics, and people like William Mitchell and Stephanie Kelton and Warren Mosler and Randall Wray and Fadel Kaboub and Scott Fulwiler and Pavlina Tcherneva and John Harvey are going to be very famous.
Well, you already are rock stars.
I'm not, but I'll come back on your podcast and I'll say, well, I told you they would be famous.
Great, I'll hold you to that.
All right, thanks very much.
All right, cheers, Steve, and have a good night. That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes where we answer your specific questions. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.